It is such a pleasure to be joining you right here on the India Development Debate this evening. I'm Supriya Shrinate. There is sufficient liquidity in the banking system and there is no need for any panic measure just yet. That's the word from the RBI and its governor, which refused to unveil any big measure to step up fund flows to NBFCs. So there is no relaxation in the reserve cash requirement for banks, although the liquidity ratio has been brought down by about 25 basis points, and this is going to happen up until March till it brings down the level to about 80%. Now, unveiling the bi-monthly policy review, RBI Governor Urjit Patel said that credit offtake to productive sectors is picking up pace. In fact, the rate of credit growth has surpassed the nominal GDP growth for the first time in many quarters. Bank lending to NBFCs is growing at over 50% according to him. On the interest rate front, there are pointers of a downward bias as inflation target for the second half of the current fiscal has been cut to the band of 2.7 to 3.2%. Remember, the government and the central bank have been at loggerheads over stringent lending norms over the past few months. The signals from Main Street on interest rates and liquidity is a big topic of discussion and debate right here on the India Development Debate this evening. And joining me on the show tonight, our very special guest, Urjit Patel, Chief India Economist, JP Morgan, Rashesh Shah, Preston Fickey, and Chairman and CEO, Edelweiss Group, Anand Sinha, former Deputy Governor, RBI, and Maithili Bhusnur, Consulting Editor at ET Now. Thank you, each one of you, for being with us. And if I may begin with you, Rashesh Shah, inflation projection has been sharply lowered for the second half of this financial year, 2.7 to 3.2%. For the first half of next financial year, it has been lowered by almost 1 percentage point, from 4.8 to really 3.8 percentage point to 4.2. Can this be done without the stance changing to neutral from calibrated tightening? Do you believe that that stance should also be changed, or do you believe it was going to be not possible for them to do so, given it was changed just in October to calibrated tightening from neutral? Rashesh.
Yeah, I think what has happened, the oil price has fallen so sharply, and the expectation on inflation has also fallen so sharply that it would have required a very sharp U-turn from RBI's part. And historically, RBI has always been more calibrated, more conservative, more gradual in this regard. So I think, but given this inflation projection, I think a rate cut is around the corner, because if oil price stays here, food prices stay here, and even the economy is slowing down. So I think given all these three factors, we should hopefully see a rate cut. It should have come now only, because I think it is if you interpret the information, it is required, but RBI always chooses to be more gradual and calibrated.
I'm going to come to that glimmer of hope in just a bit, but I think, Sajid, as an economist, a lot of people will say that why can the central bank not get its inflation projection right ever? I mean, inflation has undershot RBI's projections for many quarters, and it seems to be going the same way around. To maintain your stance at calibrated tightening and then to lower inflation, and this has been done rather steeply, projections on the back of very benign both oil and food prices. Many people will say that, can the central bank not get its inflation projection right?
Well, to be honest, Supriya, I mean, there's so much uncertainty and volatility both globally and domestically that I think markets generally have been unable to pick up the inflation trajectory over the last 6 months. Think of what's happened between the last review. Oil was at close to $85 a barrel back then, and people were talking about oil going to 100. Oil is now at 60. So there's been a $25 move in oil prices, which clearly affects the inflation forecast, number one. Number two, everybody had believed that there'd be some pickup in food prices as the year went on, because the minimum support price increase was quite large. We're not seeing any of that in the data. In fact, food inflation and food prices are 46% of the basket, are exceptionally benign. So I think food has consistently surprised to the downside. This is happening year after year, and at some level this is good news, because it suggests that the food disinflation in India is increasingly structural, not cyclical, and is a function of better supply management by the government. So the combination of the big undershoot in food, the 30% reduction in crude prices over the last 2 months, I think have resulted in this forecast, which I believe is quite reasonable given where we are at the moment.
Okay. To Anand Sinha then, and sir, I think a lot of people are questioning the fact that while perhaps Sajid is right that, given how uncertain things are, Rupee was at 75 last policy, it's at 70 right now. Crude oil was at 85, it was a big headwind. It seems to be now turning into a tailwind at 60. I know things are very uncertain and the RBI is right perhaps in pointing that out. But if that were to be the reason, and if RBI is indeed right in saying that both crude and food are extremely benign, on the back of that, it has been able to cut its inflation projection sharply, what explains calibrated tightening to then stay? Or do you believe that's a function of the fact that it was just changed in October? It's too early to go back to neutral right now, and they would, like the governor says, want to rely on some more data inflow to see the durability of inflation.
Exactly. I mean, the question is that, okay, the inflation has become very subdued, and the forecast is based on that and certain assumptions. But who knows what will happen if the oil prices can vary so dramatically in a month? What is the guarantee they will not go up again because of the geopolitical tensions, because of OPEC issues and all that? So certainly RBI would want to wait and see whether the trend which has set in, and as Sajid said, the food inflation, whether it is structural or cyclical. If it is structural, then it should become clearer within a few more months. So what RBI is looking for is the durability of the changes that have come. Now, assuming that again the oil prices were to shoot up in a short span of time, then is it all right for RBI to be in a calibrated tightening mode, then neutral, reduce the interest rates, again go back? Well, it's a question of credibility, it's a question of guidance to the markets, and therefore I think they are absolutely right in waiting to see how the whole scenario pans out. And of course the tone has been quite dovish, so I think this is the best they could have done in these circumstances.
A lot of people are saying that not just the tone has been dovish, yes, but at least it has been also able to clearly deliver a message. But I know there's something that doesn't quite impress Maithili, and Maithili, which is why I know you raised this question early on in the day today, and it's only fair I put it back to you. In some sense though, and some of us, you know, who follow RBI and have been looking at monetary policy for some time now, it's a very lopsided sort of a reaction to the inflation target. If it's over 4%, all hell breaks loose and every policy instrument is used to rein it in. But if it's undershooting, and undershooting quite substantially, then the attitude is always a little lax, and the attitude always is, let's wait for more data, let's look at more durability. If given that logic, then the durability should also be looked at when inflation overshoots that 4% mark, because after all the target is 2 to 6% and not 4% really.
Well, absolutely, Supriya. In fact, I couldn't agree with you more. In fact, most central banks which do have an inflation target are symmetric in their reactions. That means they look at a fall in from the target as well as a number above the target with equal, what should I say, concern and worry. Whereas in the case of the Reserve Bank of India, it's only when we overshoot the target that they react, as you said, as if the heavens have fallen. Whereas when they undershoot, and not just undershoot once or twice, but consistently undershoot again and again, there's clearly something wrong with their inflation model. But the RBI refuses to understand or do anything about the inflation model, and even question why is it that they are found repeatedly falling short when it comes to inflation targeting. I agree it's a very, very difficult call. I also agree that given the way oil prices have reacted, it is very difficult for any central bank really to have a very accurate fix on inflation projection. But take the other case of food inflation that Sajid talked about. The fact is that even though government gave very hefty MSP rises, almost any agricultural economist had said that we don't have the mechanism to ensure that the MSP hikes are actually implemented. We don't have the mechanism to ensure that we actually procure at the higher price. So one would expect somebody in the RBI, in fact the RBI has a great deal of talent, to have seen through the MSP hikes and say even though MSP hikes are there, the government doesn't have the mechanism, so food prices will not go up so much. So when the central bank repeatedly undershoots, in the sense that their projection is much higher than we actually see, and they have to time and again lower their projections, then it casts a little doubt on the Reserve Bank of India's credibility, ability, and its willingness to look at actions in a symmetric fashion. And that really is my angst with the Reserve Bank of India at the moment.
No, I agree where your angst is coming from, but Rashesh, I know you believe that there is, there is hope that rates will go down. The glimmer of hope, I'm presuming, is coming in from the governor's statement when he very categorically said that If upside risks were to go away, commensurate policy action will follow, essentially stating that rates will go down. But how much of that action do you believe is going to be guided by what happens to oil, which is benign, or food prices, which are again decelerating, vis-a-vis, you know, what the Fed is going to do? There are expectations that the Fed is going to hike rates almost 5 times in the next 5 months. So how much of that is going to be guided by factors like oil and food versus Fed really?
So I think they will watch the Fed, because that is I think the only concern they might have is if the US interest rate hiking and tightening continues on that, and it has any impact on the rupee, and that is the only reason RBI may not have cut at this time, because of the rupee impact that it would have had. But I think they will keep on watching it, because oil price, if it remains here, the economy continues like that, then I think eventually RBI will have to cut. So I think we are maybe a couple of months away from there, and even US is starting to slow down, and because of that, the commentary coming from US Fed also seems to indicate that even if they tighten, they will indicate that in the coming year the tightening process may not continue, and that itself may be a big relief for emerging markets as well as India.
Okay, hold that thought, because I want to take it across to Sajid Chinoy. And Sajid, I know we've discussed inflation. It's only fair that we discuss growth. And on growth, I'm a little perplexed with what the central bank is really telling us. Because when we were tracking that Q2 number, which came in at 7.1%, one thought that growth is perhaps going to be in the region of 7.2 to 7.3. These experts like yourselves were also saying that. Now the RBI is very certain and wants to stick to its own growth target of 7.4%, and plenty of reasons have been given. You know, how investment has accelerated, how credit offtake is taking place, and I'll discuss credit in just a bit. You know, oil is now a tailwind, corporate earnings are better. My only question is that 7.4%, is that doable? Or do you believe in one policy, because inflation and growth can't both be you know, revised downwards? We are staying with some 7.4 now, perhaps to be revised downwards later. Or is the optimism of the central bank really reflective on the ground? I mean, is there so much of economic activity happening which will intensify in the second half? Because second half is also going to be a period which is going to be hit more by liquidity and other concerns.
Well, the RBI's high-frequency data still is quite strong. Today's PMI numbers were strong. And again, this is a tale of multiple cross-currents, right? Yes, our own sense is growth is going to slow a little bit in the second half of the year. But, you know, our forecast for this year is 7.2 to 7.3. So I think it's hard to quibble about year forecast being different by 10 or 20 basis points. The fact is there are both headwinds and tailwinds. Tighter monetary conditions in the NBFC sector, even though the fact that banks are offsetting some of that, I think in my view still means that the flow of funds to the corporate sector will slow in the second half of the year. That's one tailwind. I think the government is serious about keeping to its fiscal deficit target, but given how revenues have panned out, we may have to see some expenditure compression in the coming months. That's another tailwind, but there are offsets here.
No, I agree with you. There are offsets there. But Anand Sinha, you've been a central banker. Is this really a question of when do rates, you know, when does growth get revised downwards? 7.4%, when you look at a Q2 GDP growth of 7.1%, you've got some of the best economists in North Block and otherwise saying it is going to be difficult to end the year higher than 7.2, 7.3. Where is RBI's optimism really stemming from? Is there data that the RBI has that perhaps the government, economic experts and everybody else does not? Because there is seemingly a disconnect between the optimism of the RBI of 7.4% and concern that a lot of economists share on those growth numbers, especially after we've seen consumption take a hit, especially after we've seen that, you know, the bounce back of the economy after Q2 numbers doesn't seem to hold true anymore.
See, the RBI growth projection of 7.4% is based on both headwinds and tailwinds. So there are offsetting factors, and I suppose based on that they have taken a decision. Now, how exactly they have taken the decision, obviously I am not in a position to comment on that. But we should also keep in mind that this is the figure which has been agreed to by the other MPC members also. So I would take it that they have their own reasons, but personally I would feel, I would agree that with the fact that the global growth seems to be slowing down. In India, we don't exactly have a liquidity crisis, but because of that, there could be some hesitation in lending, which is already happening. So I would suppose personally that the growth would be slightly lower. This is my take, and I think I would agree with the figures which Sajid spelt out. But why RBI has taken that view is difficult to say, except for the fact that they have counted both the headwinds and the tailwinds.
Okay, so you believe it's a question of both headwinds and tailwinds, and that's perhaps where this is coming from. But Maithili, I think the other point that one wants to touch upon, especially in the conference with the Deputy Governor and Governor, this point was repeatedly made, how credit growth is outpacing and is higher than nominal GDP growth rate, which essentially means, and this was I think in a reference to a liquidity question. I'm going to address liquidity just next. But as far as credit growth is concerned, and I'm constantly comparing, bear with me, Q2 numbers, because credit growth doesn't seem to be a very good indicator of what is happening in Q2, because in Q2 consumption has been a little muted. If credit growth was good, I'm wondering which part of the economy is off taking this credit. Is this the part which has retail borrowers? Is this the part that has, the large investors? I mean, which part of the credit is RBI really referring to?
Well, we don't have any further details about the sectoral deployment of credit, Supriya. So we'll have to take it the RBI statement at face value. But the fact is that last year credit growth was very low. In fact, credit has been growing extremely slowly for the past 2-3 years, ever since the RBI launched its AQR, then came cracking down on banks regarding the NPAs and recovery and provisioning. So the numbers look a little deceptively good, purely because the base was so low, there was no growth at all. And sectoral deployment of credit, we don't know enough. But given the fact that the GDP numbers suggest that there has been some rebalancing away from consumption towards gross capital formation, it would be really good if this credit offtake is going to infrastructure and to the more productive sectors of the economy. But as of now, there is nothing to substantiate that, because as we've seen from the infrastructure sector, there is virtually no lending to infrastructure from banks at the moment. NBFCs too have stopped lending. So I really do not know. We'd like to see further details, but I think this would be purely as a result of comparison with a very, very low base.
Rashesh, what's your view on this, the credit offtake? And I think Maithili is right. One is a little confused about which part of the credit in the economy are they really referring to. If credit offtake is good, then I'm presuming the next possible impact of that is going to be on investments. And we are not seeing investments rise in double digits, even though the governor seems to tell us here that nominal GDP growth rate is being outpaced by credit offtake. I wonder what's happening to credit and which part of the Indian economy is really off-taking credit right now. Rashesh?
So I think obviously credit has actually picked up, but the first half was also, NBFCs were growing fairly well and all, which may not be the case in the second half. So I think that also we have to factor it in. What currently RBI has chosen to do for the last couple of months is ease off on liquidity, but not on rates. And what is currently happening is, though the liquidity has eased off in the last eight weeks, the credit flow has not gathered momentum, because the liquidity, what we call the multiplier effect or the real velocity, is not as much, because a lot of the PSU banks are under PCA, so there is a lot of liquidity stuck in the system, which is not resulting in credit flow. So we should always be careful that liquidity is not always equal to credit flow. And in order for credit flow to happen, I think banks will need to become more aggressive. I think if RBI had done a CRR cut, it would have been very, very helpful, because a cut in the CRR will also improve banks' profitability and could have unleashed some amount of animal spirits. So though there is the credit growth data, but this is the first half, so we should not be looking in the rear view mirror. We have to actually look ahead of us, and given the liquidity crunch that has happened and the NBFC slowdown, you may not see the same kind of credit growth in the second half, and we need to correct for that and compensate for that.
Okay, Rashesh, give me a minute, because I'll go across to Anand Sinha. And Mr. Sinha, this is not just Rashesh Shah's view, but this is a view that a lot of people have now put on the table, that for liquidity concerns to be addressed, why not go for a CRR cut? Now, there are two ways to look at this. CRR is a more permanent sort of an instrument which can boost permanent liquidity. The RBI, in fact, in his press conference, the governor responded to a question saying, but why the MPC did not have to discuss CRR, it wasn't their mandate. But even if it were, why discuss CRR? Because we've got too many instruments before that. What's your view? Do you believe at a situation like this, when there's such a clamor for liquidity easing, is CRR a very potent and perhaps a little more potent instrument that the RBI should not be using?
Well, CRR is an instrument which benefits the entire system because as far as OMOs are concerned, again it depends on how much collateral you are having. But we also have to keep in view that CRR cut may be kept in reserve. It need not really be used straight away if it comes to that. Because if you remember, during the crisis time, CRR cut was used quite extensively. We are certainly not into that kind of situation, and as long as OMOs are doing their work, it should be all right, and we should CRR cut could be resorted to, but only if the situation becomes very difficult. This would be my view.
No, CRR cut is a very potent sort of a weapon. I don't know if it can be your first port of call. But Sajid, as far as liquidity is concerned, I don't think the clamor is just from the government, and that's the big tug of war. But the clamor is also from the industry. The RBI has very categorically stated that system-wide liquidity is absolutely all right. And you know, way forward, the RBI is even willing to look at more OMOs up until March and all of that. They don't want to be a NBFC specific liquidity. Is that the message that the RBI wanted to deliver to the markets, and have they really done that?
Well, I think on liquidity, basically the policy of the RBI for a long time has been twofold. That what the RBI seeks to do is keep the weighted average call rate close to the policy rate, which has been happening, and secondly, that any durable outflows, either through currency in circulation or through selling dollars, will be completely offset by durable inflows, which is either buying dollars and injecting rupee liquidity or through open market operations. And I think that policy has been followed. So, you know, this year we've had close to 1.7 or 1.8 trillion of OMOs, and the suggestion today was we'll get, you know, maybe the pace of OMOs has to be stepped up in the next 3 months. So expect a large quantum of OMOs December, January, February, March, so that we could end the year with about 3 trillion, which would be a very large number. Now, this is happening because currency in circulation in the economy has picked up, has been strong all year long, and you've had the RBI in the first 6 months selling dollars. So I think the liquidity policy they've been following kind of predictably, which is we will try and keep headline interbank liquidity close to neutral and offset any durable outflows with durable inflows, and I think that will continue.
Okay, I'm sort of running here over time on the show. But Maithili, a quick last word to you. The decision to bring in SLR to 18% for over some quarters, and the external bank part of the whole thing, which the RBI has done, which is benchmark against external rates. You know, there is a very divided opinion there. There are those who believe that this is perhaps hinging upon the commercial decision making of banks, and there are others who believe this is a transparent and a pro-consumer move that should have been done a long time back. Which side of the fence are you on with this?
Well, I'll take your second question first, Supriya. I'm strongly of the belief it is not for the RBI to prescribe either the base rate or the MCLR or which external benchmarks, you know, give a number of external benchmarks and tell them you should follow one or the other of those, because the whole idea of competition is that it will bring the price to the best possible for the consumer. If you have good competition and freedom of entry and exit, there is no reason why you cannot. Competitive forces will not ensure that the consumer gets a good deal, because if one bank is charging me 18% rate of interest for a home loan, another is charging me 15%, I will go to the latter bank. I don't need the Reserve Bank of India or the regulator, and nowhere in the world is this done. It was for the banks to decide what is the rate of interest they're going to charge to the consumer. So this, I think, is an unnecessary interference by the Reserve Bank in what is a commercial decision of the bank. And mind you, the second committee which was set up by the Reserve Bank of India to go into this issue, it didn't have a single member from the commercial banks. He heard the central bank a committee set up purely of officials from the central bank who have no clue really of how commercial bank lending is done, deciding for commercial banks what benchmark they should adopt. Perfect competition, freedom of entry, freedom of exit is the best way to go. On the SLR issue, yes, it is because if you have a liquidity coverage ratio and you have SLR, they're both basically duplicating each other. So you can bring down SLR, but the only question is that at times it might make it difficult for government to raise the resources it needs to meet its fiscal deficit. So that is the only question mark. Government may have to pay a higher rate of interest, and that one is not sure is a very good move. It needs to be done, but ultimately in the long run we will suffer for it. One needs to wait and watch.
No, precisely, and I think the question that I haven't asked, and I'll take a quick word to Mr. Anand Sinha, and it's a little bit out of policy, but this was a policy press conference. 3 questions were put forward to the governor as far as the tug of war with the government is concerned, and he very categorically stated he's going to only look at monetary policy resolution and talk about policy rates. Did he play too safe? Should he have come on record? Should he have, just for the sake of camera, said there is bonhomie?
I think with the situation being what it is, he has steered away from any controversy, and I think that is the right thing to do.
Okay, that's a short, crisp answer. Expect that from a central banker. But thank you very much, Mr. Anand Sinha, Maitli Husnul, Rashesh, and of course Sajid Chinoy for joining us on this edition of the India Development Debate. There is a tug of war. Liquidity will be a talking point. Liquidity is in fact on the agenda, much like the supervision of the RBI board on the 14th of December. For now, the RBI has said there is a pause, but has given a huge glimmer of hope when the governor said if upside risks cease to exist, then there will be commensurate policy action, essentially hinting at policy rate cuts next policy if oil and food prices continue to be benign. We take a quick breather. Thank you very much for being with us on this edition of the India Development Debate. Coming up at 9:30 p.m. this evening, the campaigning ends in the states of Rajasthan and Telangana that are going to polls. We get you a special coverage of what these elections have really meant, where are the state issues, and who is likely to come out victorious.